After studying this module, you shall be able to learn about equity financing, learn about bond financing, and know others financing such as bank, direct loans, government, and development bank lending. MNCs normally use long-term sources to finance the long-term projects. Basically, the sources of funds for MNCs and its subsidiaries can be split into two major categories: cash that is internally generated by the MNC and cash that is externally provided from the equity or debt markets. The purpose of this chapter is to analyze basically the external sources of finance for MNCs. The potential sources of external capital are bonds, stocks, including debt and equity financing, and loans. At the same time, the chapter also focuses on the factor affecting the financing of subsidiaries and later on the overall structure of the financial structure at global level. Equity financing. For assessing the capital from a wide pool of investors, a company has to list its shares on a stock market. This led to the list at primary market at the time of an initial public offer known as IPOs. Apart from this, shares are also traded at secondary market with an objective of forward-looking valuation of the company's activities. In this section, we examine how and why MNCs list their shares on international equity markets. Normally, MNCs list their shares on the stock exchanges of the countries in which they have their headquarters. But at the same time, there are many MNCs that list their shares on stock exchanges located in other countries. Listing on foreign stock exchanges. An increasing number of MNCs are finding ways to broaden their investor bases and raise capital by cross-listing their shares on different foreign exchanges. Cross-listing refers to a firm having shares listed on one or more foreign exchanges in addition to the home country stock exchange. Cross-listing obligates the firm to adhere to the securities regulations of its home country as well as the regulations of the countries in which it is cross-listed. Therefore, cross-listing has both advantages and disadvantages. Advantages of cross-listing. A firm may go for cross-listing due to the following reasons. First, it is now widely recognized that more liquid stocks have lower expected returns and hence higher prices than less liquid stocks. Thus, cross-listing on a larger, more liquid market that lowers transaction cost for investors and improves liquidity, induces expected returns and hence increases the stock prices. Second, cross-listing enhances the ownership base outside the national frontier, which may reduce price fluctuations. Third, cross-listing may also be helpful in supporting a new equity issue. Fourth, cross-listing also brings the firm's name before the investors and customers. Fifth, one motive behind the cross-listing is to affect favorably the equity price. Disadvantages of cross-listing. As we know, listing of a company on stock exchange is not costless. Even cost increases when we go for listing on a foreign exchange. There are direct one-time costs such as registration and listing fees, and there are the perennial cost of additional reporting and disclosure requirements. In this way, the benefits of listing on foreign exchanges is balanced out with the cost of implied commitment to full disclosure. For example, the disclosure norms in US are stringent and are costly, and the norms are such that if the norms are adhered, the other market norms are automatically fulfilled. Procedure of issue of international equity. A. Size of issue and the government approval. The first step for a company going to issue international equity is to decide about the size of the issue, target market where the issue will be launched, the appropriate price of the issue and so on. In this case, it is also necessary to get the approval from the government of a country where issues will be made. For all this, companies have to approach lead manager to complete the formalities regarding the issue. Lead manager is often an investment bank that facilitates issue of the share for a fee. B. Custodian bank. After deciding the size and getting the approval from the government, The next step is to deposit the shares to be issued with the custodian bank located in the home country. The role of the custodian bank is to get the deposit of the equity shares as security for the issue of ADRs or GDRs. ADRs and GDRs. The next step is to launch the ADRs or GDRs. The depository, that is bank or financial institution situated in an international finance center, usually perform the functions as a link between the investor and the issuing company. On the information gathered from the issuing company, the depository issues the depository receipts. For Americans, it is American Depository Receipts, that is ADRs, while it Global Depository Receipt for the international finance market outside USA. C is voting rights. After its issuing the equity to the investor, the next concern is to see whether they are eligible to vote in the meeting. Since GDR investors keep changing from time to time, they do not seem interested in voting rights. At the same time, the rights of voting cannot be denied to them. They can vote either on the basis of their holding or according to the wishes of management. D. Cost of equity issue. Like domestic issue, there is also a cost for issuing equity at international level. Although the cost of international equity is not large as it appears, it is around 3% to 4% of the issue amount. E. Documentation. International issue of equity consists of the following documents: prospectus, depository agreement, underwriting agreement, agreement with the custodian, trust deed, agreement with the listing stock exchange. Bond financing. Like equity financing, MNCs also raise funds through bond financing. International bonds are a debt instrument. Such bonds are normally issued by some global agencies, governments and companies. The purpose is to borrow foreign currency for a specified period of time. Before learning about the bond financing at international level, this section is an attempt to first make reader familiar about the different types of bonds existing at global level. A. Foreign bonds and Euro bonds. Foreign bonds are denominated in the currency of the country where they are issued, and that's why they are subject to regulations of that country. Whereas Euro bonds are not denominated in the currency of the country where they are issued, and hence they are not subject to regulation of that country. Euro bonds are underwritten by the underwriters of multinationality, whereas foreign bonds are underwritten the underwriters of the country where they are issued. Euro bonds maturity depends upon the need of investors of number of country, whereas foreign bonds maturity depend upon the need of investor of a concerned country only. Foreign bonds are subjected to the rules and regulation of the country where they are issued. Euro bonds, on the other side, are not subjected to such norms. B. Global bonds. A bond which is issued by the World Bank is known as global bonds. It was issued by the bank first time in 1989 to 1990. After 1 year, since 1992, such bonds are being also issued by corporates as well. The most important fact about this bond is that it is denominated into number of currencies such as Australian dollar, Canadian dollar, Japanese yen, Swedish krone and euro. C. Straight bonds. Straight bonds carry fixed interest rates as well as fixed maturity. It is a traditional type of bonds. Bullet redemption bond. It means repayment of principal is made at the end of the maturity and not in installments every year. Rising coupon bond. It means coupon rates rises over a period of time. It gives advantages to the borrower for the early interest payment. Zero coupon bond. As the name suggests, it carries no interest payment. Due to this feature, it is always issued at a discount. Currency option bond. It means the investor has the right to receive payments in a currency other than the currency at which bond issued. Bull and bear bond. They are indexed to some particular benchmark. The bull bonds are those where redemption amount rises with the rise in index, while the bear bond are those where redemption amount falls with the fall in index. Bond with warrants. Some bonds are issued with warrants. A warrant is an option to buy a stated number of common shares at a stated price during a prescribed period. D. Floating rate bonds. These bonds are also known as floating rate notes. As the name itself speaks, such bonds do not carry fixed rate of interest. Historically speaking, such bonds were issued for the first time in Italy during 1970, and now they have become common in recent times. E. Convertible bonds. Such bonds are convertible into parent common stock and have become popular because the market for straight bonds has weakened. Convertible bonds normally command a high market value because conversion price is usually fixed at a certain premium. F. Cocktail bonds. Bonds which have denominated into a mixture of currency are known as cocktail bonds. For example, SDR bonds represent a weighted average of 4 currencies. The investor of cocktail bonds automatically gets the benefit of currency diversification. In such bond, the foreign exchange risk arises on account of depreciation of one currency is entirely offset by the appreciation of another currency. G. Samurai bonds. Samurai bond is a bond which is denominated in Japanese yen and issued by the non-Japanese companies in Japan. H. Yankee bonds. Yankee bond is a bond which is denominated in US dollar and issued by the non-US companies in the USA. Procedure of issue of international bond. The procedure of issuing international bond involved different stages. First and foremost step is to select a particular lead manager on the basis of performance. Normally, the lead manager is a commercial bank or investment bank. The lead manager advises the issuer regarding the timing, pricing, maturity, and the size of the issue. They also advise about the buyer's potential. After taking advices from the lead manager, the issuer prepares the prospectus and other documents. The lead manager charges fee for their valuable advices. Step 2. At this stage, issue is marketed. The investors try to see the issuers from the credit rating as well as the person who underwrite the issue. Here, underwriters charge the underwriting fee from both company and investors. Step 3. At this stage, the process of selling of bonds take place. For this, lead manager functions as a selling group, and for this, it charges commission at varying rates. Step 4. Like international issue of equity, bond issue also consists of the following documents: prospectus, subscription agreement, trust deed, listing agreement, agreement with agency, underwriting agreement, selling group agreement. Other financing. Parallel loan. A parallel loan involves an initial exchange of funds between firms in different countries such that the transaction is reversed sometime in the future. For example, suppose that a subsidiary of ABC Limited in Japan needs some yen funds and the subsidiary of PQR Limited in Australia needs Australian dollar funds. ABC Limited lends the Japanese subsidiary Australian dollar funds while PQR Limited lends ABC's subsidiary an approximately equivalent amount in yen. After an agreed period, the Australian subsidiary pays off the yen loan and the Japanese subsidiary simultaneously pay off the Australian dollar loan. In this case, there is no foreign exchange risk because no currency conversion takes place. Credit swaps. Credit swaps refers to an available amount of loan for a foreign subsidiary without spending any amount of funds abroad. Opposite to parallel loan, credit swap involves the exchange of currencies between a bank, say DCB, and a firm, say ARC. It should be noted that credit swap does not involve the exchange of currencies between either two firms or two banks. How credit swaps work is explained in figure 2. ARC places Australian dollar funds with DCB in Australia for a certain period. DCB then instructs its Japanese correspondent bank or subsidiary to grant ARC's Japanese subsidiary a yen loan. On the maturity of the loan and deposit, the correspondent bank receives the loan payment, whereas ARC receives the matured deposit. Government lending. It is something different source of finance. It is random in nature because when government lending takes place is not sure. Generally, governments of countries acting as hosts to the foreign direct investment may provide financing when they believe that the underlying project will generate jobs, facilitate transfer of technology, or training to the local workers. The forms of government lending may be in the nature of loans, subsidies, grants, and loan guarantees. Lending by international development institutions. Apart from government lending, there are a number of development institutions that also provide loans for financing. Normally, loans are given for financing some infrastructure projects. Such loans are granted to the host government for the companies working there. MNCs list their shares on the stock exchange of the countries in which they have their headquarters. But at the same time, there are many MNCs that list their shares on stock exchanges located in other countries. Cross-listing refers to a firm having shares listed on one or more foreign exchanges in addition to the home country stock exchange. Global bonds are those bonds which are issued by the World Bank. It was issued by the bank for the first time in 1989-90. After 1 year, that is since 1992, such bonds are being also issued by corporate as well. Straight bonds carry fixed interest rate as well as fixed maturity. It is a traditional type of bonds. Bullet redemption bond is a bond where repayment of principal is made at the end of maturity and not in installments every year. Rising coupon bond is a bond where coupon rate rises over a period of time. It gives advantages to the borrower for the early interest payment. Bond with warrants means that bond is issued with warrants. A warrant is an option to buy a stated number of common shares at a stated price during a prescribed period. Floating rate bonds are also known as floating rate notes. As the name itself speaks, such bonds do not carry fixed rate of interest. Historically speaking, such bonds were issued for the first time in Italy during 1970 and now they have become common in recent times. Convertible bonds are convertible into parent common stock and have become popular because the market for straight bonds have weakened. Convertible bonds normally command a high market value because conversion price is usually fixed at a certain premium. Cocktail bonds have denominated into a mixture of currencies. For example, SDR bonds represent a weighted average of 4 currencies. Samurai bond is a bond which is denominated in Japanese yen and issued by the non-Japanese companies in Japan. Yankee bond is a bond which is denominated in US dollar and issued by the non-US companies in USA. A parallel loan involves an initial exchange of funds between firms in different countries such that the transaction is reversed sometime in the future. Credit swaps refer to an available amount of loan for a foreign subsidiary without sending any amount of funds abroad. The forms of government lending may be in the nature of loans, subsidies, grants, and loan guarantees.